Good evening and welcome to another class in advanced taxation. The last time we talked about capital gains tax and we entered into taxation of business income. This was where we stopped in our last class, and we said we are going to update a question. But before we update the question, we would like to know or give a rundown of what we did the last time. But hold on a moment. Before we go to what we did the last time, I would like to introduce you to two things here. This is question trend for advanced taxation from November 2014 down to May 2019. This is 5-year questions trend. This is like 10 years and 10 diet trend. If you are to do from November 2019 down to May 2024, that is another 10 diet or 5 years question. So if you are to merge all together, you have 10 years questions, 20 diets. I'll be sending this to you after today's class so that you can see the trend and you can also carry it further from 2019 November to date. All right. Now, how will this trend help us? It means that if you have learned something, you need to go to the question trend and check which question has the topic that you've just learned so that you can do the assignments I will be giving to you, or so that you can solve on your own. Now that's one. The second thing is that when you solve, you could put the date or you just tick it off. Then there is the companion to it, which is called past question treated register. This is also developed by me, the two of them, where each of the courses that you are having, you can fill this, and it can be used for both foundation skills and professional levels. But what you are concerned here is this ones for skills and professional level. So we could as well start. I will send this to you so that you can also fill it and make good use of it. So let's start by filling this. You could come here and take the name of the lecturer and say the name of the lecturer. Just a moment. The name of the lecturer, you could say, just come down here and put the name of the lecturer. Hold on. I don't know why this thing is not writing. So you could go here now and bring the name of the lecturer, and you just put his name down. What was his name? Chima. You can put the full name complete. And you can say this is a November diet. So you can come here and say November 2024. Okay, so when that is done, you can now check the past questions that you want to treat. And when you treat the past questions, you can now write them down. All right, so this will be sent to you so that you can as well have it for your treatment. All right, so now let's go to what we are supposed to learn today. Now, we said before that business income includes sole proprietorship, partnership, and company. Our aim here in today's class is about the company. We'll be talking more about the company. And we mentioned that the basis period for dealing with income, taxation of income, is preceding year basis. So this is on preceding year basis. Preceding year basis. That is how we treat the income taxes. So it means that we have something called year of assessment, which is the tax year in which the government evaluates and assess the book. Then it will be based on the basis period, which we said is going to be preceding year basis. Okay, now that that is done, we also said that in a normal basis period, a normal basis period has three characteristics. And we mentioned that the three characteristics are that one, it must be 12 full months. So it is 12 full months. So once it is more than 12 or less than 12, it is not a normal basis period. We also mentioned that it must start where the previous one stopped. So there is no gap or overlap. No gap or overlap. Where once the previous one starts, the current one will, where the previous one stops, rather, the current one will start. Where the current one stops, the one after it will start. And we said it must be the only period ending in the preceding year. It must be the only period ending in the preceding year. So this is the characteristics of the normal basis period. Then we said that there are three situations in which we will not have a normal basis period. And we said these three situations will be in the form of commencement, then there is change of accounting date, then there is cessation. So these three are situations in which we will not have our normal basis period. Now, for us to understand how this basis period works, we are going to be using the New Finance Act, from 2019 to 2023. This is what your exams will be testing you on. But it is possible they can test you before the Finance Act 2019. But for now, this is what we will be concerned with. And so, for us to learn about it, we will need to use the circular that was prepared by the FRRS. Now, this circular is a clarification on commencement and cessation rules. So we are going to be looking at these cessation rules and these commencement rules, and we are going to see how we can apply them. Now, this is dated June 3rd, 2021. So this is about 3 years old. Now, this circular is issued for the information and guidance of the general public, taxpayers, and tax practitioners in line with the provisions of the relevant tax laws. This circular replaces FIRS Information Circular 2020 June of of 29th April 2020. So there was a circular that came out in April 29, 2020, and so this 2021 June 3rd has replaced it. So, introduction. This information circular provides clarification on the administration of various amendments to relevant tax laws with respect to commencement, cessation, and business reorganization. So the relevant sections here are Companies Income Tax Act Section 29, subsection 3, 4, and 9, and Capital Gains Tax Act Section 32, and the Personal Income Tax Act. Our, our focus will be on Company Income Tax Act and the Personal Income Tax Act. All right, so let's go to commencement of trade or business. Sections 29, subsection 3 of the Company Income Tax Act and section 24 of the Personal Income Tax Act, as amended, eliminates the occurrence of overlap of basis period upon commencement of trade, thereby ensuring that the profits and income of a particular year are only assessed to tax once. Now, before 2019 or before 2020, because this act came into effect February 1, 2020, before now, there used to be an overlap between the first year of business and the second year. Sometimes, not even sometimes, most times, the first year of business is assessed to tax twice, meaning that if your tax is 30% on your assessable profit, the first year's profit is assessed twice, and you pay like 60% for that first year business only. And because of that, most businesses would always want to make a loss so that there will be a loss for the 2 years. Now that was a strategy used by people, but now the overlap has been removed to make sure that it is assessed to tax once. And there had been an exam case in which the first year profit is assessed to tax 3 times. So it is being used for the first year, used for the second year, and used for the third year. And so that's like 90%. So you can imagine if there is a loss, the government will not collect any business tax for 3 years. And so the overlap has is the taxation practice in Nigeria. Now look at the basis of assessment for new trade or business. Section 29 of CETA and Section 24 of PITA. Now, why are we using CETA? CETA is for companies, PITA is for sole proprietorship or business names. So these sections, as amended, shall provide that tax shall be assessed in the event of new trade, profession, vocation, or business on preceding year basis. Now, why is this important? This is important because in the previous tax administrations before 2019 Tax Finance Act, there used to be tax assessed on actual year basis. It means that the second year and the third year were being assessed to tax on actual year basis. Even the first year too is assessed to tax on actual year basis. So 3 years is being assessed to tax on actual year basis. And in fact, there's to be a comparison between actual year basis assessment for year 2 and year 3 with preceding year basis. And so they call that right of election. Now with this, the right of election was abolished. And in cessation, which we'll go into later, there also was actual year basis used to assess certain taxation. So you see here that every business must be assessed on preceding year basis. As such, the income of a given year is assessed to tax in the immediate following year of assessment, meaning that 2023 business is being assessed to tax in 2024. Let's read further. Now let's look at the first year. Section 29, subsection 3A of CETA and section 24A provides that for the first year, the assessable profit shall be the profit from the date in which the company or individual commenced to carry on such trade or business to the end of the first accounting period. Now, what does this mean? It means that whenever you are carrying out a business, you must first of all know the date of commencement. So your date of commencement. Okay, let me write it completely. Date of commencement must be known. So you have date of commencement. Then that is one thing you should know. Then you will know the account year and date. So it means that the profit for the first year shall be from the first day the business commenced to the first accounting end date. That forms the first accounting period. Now it says here that as such, a company or an individual shall not be assessed to tax on the basis of the actual profit or income in the year in which it commenced business. Meaning that if it commenced business in 2020, you will not assess it to tax on 2020, but you will go to 2021 and assess it to tax. The profit or income of the first accounting period are assessed to tax in the year of assessment immediately following the year in which the business commenced. But let's see an illustration given here. Now, in this illustration, a company or an enterprise. So you see here, either a company which is a limited company or an enterprise, a business name or sole proprietorship. Now they commenced business on 1st July 2020 and they make up their account to 30th September the same year. Now, what does it mean? It means that your first year of assessment will not be 2020. So it means you need to know which year the business commenced. This is 2020. You go to the next year, which is 2021, and that will be your year of assessment. Now, what will be the basis period? It will be from the date the business commenced, which is July 1, then it will end on 30th September of that same year. So to write it here, it will just be 01/07/2020 to 30 September is 9 2020. So this is just 3 months. So this is a 3 months figure, 3 months figure. So you see here, the first year, this is an abnormal basis period. So you see why we said the commencement of a business is abnormal, because this is not up to 12 months. This is abnormal. Now that's illustration 1. We go to illustration 2. A company commenced business on January 1, 2019. So this is your date of commencement. And it makes up accounts to 31st December 2019. So now this is account year end. Account year end. All right. Now, the first year of assessment shall not be 2019, but shall be 2020. All right. And the basis period shall be when the business started, January 1, 2019, to when is the first accounting period going to end? 31st December 2019. Now, that is the assessable, the basis period. All right. Now, they said for an individual that commenced business on 1st January 2020. Now, this is a commenced business 2019, 1st January, right? Now, we say the year of assessment is 2020. Now, if the individual, now, the first one is for company. If a company commenced business 2019, this applies to him. But if an individual commenced business on 2019, it doesn't apply. So for an individual that commenced business, it must be on 2020, 1st January, and it makes up its account to 31st December. The first year of assessment is going to be 2021, right? And it's going to be the basis period is going to be on preceding year basis, January to December of 2020. I believe we understand this now. Now, the thing is that 2020 year of assessment is when the Finance Act takes effect, and it affects businesses which account year end is in 2019. Any business which account year ends in 2019 falls under this regime. I'll write it down here. The Finance Act 2019 started with year of assessment 2020, and it deals with those whose account year end falls on 2019. So it may be that they started business January 1 and end in December 31st, 2019. They fall into that. It could be that they start business in maybe September 1, 2018, and it ends in August 31st, 2019. As long as the year end is 2019, it falls into this. It could be that it started December, December or February. It started February 2018 and is ending in January 2019. It also falls into this. All right, so let's look at illustration 3. A company commenced business on 1st April 2019, so this is the date of commencement, and makes up its account to March 31st, 2020. This is account year end. Now, this is complete 1 year. So, because it starts in 2019, you will not say because it starts in 2019, you will not say year of assessment is 2020. No, this is wrong. You look at the account year end. That is what matters. The account year end is 2020, and the year of assessment must be 1 year after. That makes it a preceding year basis. So it means the account year end or the year of assessment will be 2021. So what you do is when you get your account start date, which is the date of commencement, go and look where the company makes up its account. In the first example and second example, they were falling on the same year. But in this third example, there was movement from 1 year to the other. So look at where it ends. March 31st, 2020. So it means your year of assessment will be 2021. And the profit to be assessed to tax will be that of April 1, 2019, where the business commenced, and end it at the account year end. I believe we are understanding this. Now, similarly, if an enterprise commences business on April 1st, 2020 and makes its account up to 31st March 2021, the first year of assessment is 2022 because 2021 is where the first accounting period ends. So your first year of assessment will be 2022, and it will be the income from when it started business in 2020 April and ending in March 31st, 2021. Now that's illustration 3. Let's go down now. We have seen the first year. So let's make a note here on the first year. How do we identify the first year? First thing to do is first identify the date of commencement. That's the first thing. Next, find the account year end. The basis period will be from date of commencement to first account year end, and the year of assessment will be 1 year. Okay, not 1 year, will be the year after the account year end. Now we will see that displayed when we are solving some questions. So we've done the first year. We will now go to the second year. Now let's look at the second year. They said section 29 subsection 3b of CETA and section 24b of PETA stimulates that for the second year, the accessible profit shall be the profit from the first day after the first accounting period to the end of the second accounting period. So it means here that there is no overlap or gap, meaning that where the first accounting period end, the next day, immediately the next day after the first accounting period ends, that is where the second accounting periods begin. Now, this is to make it a normal basis period, and it shall end in the second accounting period. Now, it says here, from the above provisions, the profit or income accessible to tax in the second year shall be the profit or income arising in the second accounting period only, and that is the accounting period immediately following the first accounting period. So there is no overlap, there is no gap. Now let's look at an example. This example will show us both the first and the second year of assessment. A company or enterprise commenced business on July 1, 2020. And we said before, when you want to solve this, you first of all identify the date of commencement, which is July 1, 2020, and makes up accounts to 30th September 2020. So this is the first account year end. Why is year end? And they say, and subsequent years. So every other year, it is ending on September 30th. Now, what do we need to do? Okay, you will set up this is your year of assessment, and this is your basis period. So the first one, we say is going to start from July 1, 2020 to what date? To 30th September 2020. I didn't write it well because of space. Okay, let me clean this off here. All right, so let me do it up here again. So your first year of assessment, we don't know it yet first, but your basis period will be from July 1, 2020 to what? 30th September 2020. Now, because this is where your accounting year ends, is in 2020, your year of assessment is 2021. And that is what it is telling us here. The first year of assessment is 2021, and the profit shall be those of 1st July 20th, 2020 to September 30, 2020. Now, the second year of assessment will naturally be 2022. Okay, but we will not write 2022. We will first of all do the basis period. The basis period, this one shall start one day after this ends. So this is going to be 1st of October 2020. Then it's going to end they say subsequently it's going to be ending on 30th of September, but now this is going to be 2021. And because this is 2021, this is 2022. So you see it here, the second year of assessment shall be is 2022, and the income shall be 1st October 2020, which is one day after this first year of ended, and it will end in September 30th, 2021, which is the subsequent years, because they said your account ending date is always September 30th. So it means that when you have identified the accounting date for the first year, all you need to do is repeat it, but change it by one. Repeat it, change it by one. I do believe we understand how to do the first year and how to do the second year. Now, we will go to the third year. Let's look at the third year. They said the section 29, subsection 3C of CETA and section 24C of PETA provided that for the third year and for each subsequent year. So what applies to the third year applies to the subsequent year. The assessable profit shall be the profit from the day after the accounting period just ended. So what it means is that where the second accounting year ends, the day after, you start the third one, and you are going to end it on the account ending date of the company. And that is how you'll be doing it subsequently. Based on the above, profits or income accessible to tax in the third and subsequent year shall be the profit or income from the accounting period immediately preceding the year of assessment. Now let's look at illustration 5 and illustrate it again. Now, a company or enterprise commenced business on July 1. So we have identified our date of commencement and makes up account to 30th September. So I'll just say this is account year end. I've identified these two dates. So what will I do? I will just come here now and say this is my year of assessment and this is my basis period. So I will start with the basis period to derive my year of assessment. That is the best way to do it. Now, this is the first year. We'll start from the date of commencement of business, which is 1st of July 2020. That is the date it commenced. What is the first accounting year? The first accounting year end is 30th of September 2020. So that means if it ends in 2020, the year of assessment will be 2021. And that's it. Now, you will know that if you've done it, this one will be 2022 and this will be 2023. And you also know that this one will always be 30th. This will be 1 year after. This is 2021. And this is going to be 30th 9 2022. Now, what should you put here? This will be 1 day after this has ended. So this is 30th September. The first one will be October 1, 2020. And now the next one here will be October 1, 2021. So you see the style, the technique I use in deriving my basis period. And that is in line with what this is saying, that the first year of assessment is 2021. The first year of assessment is 2021, which corresponds to what I did here, 2021, and the profit shall be assessed, the profit or income to be assessed are July 1st to 30th September 2020, which is what we did here. The second year of assessment is 2022, which corresponds, and the profit or income to be assessed are those of October 1st, 2020 to 30th September 2021. And now the third year of assessment is 2023, and the profit or income are those of 2021 October 1st to 30th September 2022. So that's for the 3 years. So what you should know is that for commencement of business, the relevant year, I'll come here and say commencement of business, commencement. Now the relevant years are the first 3 years of business. So the first 3 years of business are the relevant years. So now, when you get the first 3 years, you have set the pattern for how future years will be. So it means that for 2024, you would have followed the pattern you done in 2023. That's why they said for the third year and subsequent years. So 2024 will be October 1, 2022 to September 30th, 2023. So that's it. All right, let's go further. Now look, they said, note, there will not be any overlap of basis period where the profit of all the relevant years are computed in line with the new provision. So in line with the new provision, there will not be any overlap of basis period. Now for this Finance Act 2019, there is no overlap of any period. However, there may be an overlap in the basis period in the third year of assessment due to what they call transitional issues. Now, these transitional issues will affect business that commence in 2018, that's companies, or individual that commenced in 2019. So if individual commenced in 2019, there will be a translational issue. So that means what they mean here is there will be a mixture of the old law and the new law. We said before that the Finance Act 2019, say Finance Act 2019 starts from year of assessment 2020, and it affects companies that start in 2019 or individuals that start in 2020. So if you start in 2018, you'll have part of your business subjected to tax in the old regime, then part in the new regime. If your company starts a business in 2017, it's possible that all your 3 relevant years will be the old Finance Act or the old tax law. For companies, if you start in 2017, your year 1 to year 3 will be assessed on the old law. Whereas for individual, if you start from 2018, to be assessed in the old law. All right, let's look at illustration 6 to see what they mean by that. So it means that you are going to now learn something about the old law, which is also important because you may have a question where this will happen. Now, a company commenced business on 1st April 2018. I said before, for businesses, that's company, you should be watching out that it must be 2019 and later. That is when the new Finance Act 2019 will act. For individuals, it must be 2020. Now, this is a company that is commencing in 2018. So, and now they said it makes up its account to, so this is the date of commencement here. Date of commencement is 2018. This is the account year end in 2018, December. They said the company's first year of assessment falls under the old provision. And I will tell you the old provision now. So we'll look at the old provision. The old provision states that when a company starts operating or commence business, the first year of assessment is always actual. So you look at the year it commenced is 2018, you use the actual year of assessment, the actual year that the company commenced business as the year of assessment. And the basis period for the first year shall be whenever the business commence. Whether, okay, it commenced here now in April 1, 2018, and it doesn't matter what your account year end is. It doesn't matter. The first year always end in 31st December of that same year. So assuming your business is ending in September 30th, it will ignore it for the first year. The first year will be from the date you commence business, and it will end in December of that year. That was the old law. So that's what they mean here. Now, the second year still falls under the old provision. Now, what happens in the second year? The second year of assessment, which is going to be 1 year after the first year, is supposed to be 2019. So it means that your first year of assessment is 2018. Naturally, the second year should be 2019. Now, your basis period will be the first 12 months of your business. Your first 12 months of business. So what it means that you will now go back to your date of commencement and put the date again. 1st of April 2018. Now that is your first date of commencement, and it must be exactly 12 months old. How do I calculate 12 months old? I don't count my fingers. What I usually do is that if this date of the start of the basis period is 1st of April, I will ask myself, what is yesterday's date if today is April 1? It means yesterday's date would have been 31st of March. Now, if this is 2018, now this will become 2019. So that means this is 1 year. But feel free to count your fingers if you want to. But this is what I do. If the start date is April 1, 2018, I look at the month and the date and I say, if today I am standing in April 1, yesterday is going to be 31st of March. That means my current business period is going to end 31st of March next year. So that is what I did here. So that is the second year. And you see here, this is not preceding year basis. And this is also not preceding year basis. They are all under the old provision. Now, it is a third year that you will see preceding year basis. Now, take note, they said the third year of assessment, which is naturally 2020, shall be the profit for 2019. So it means here now, it is the third year that you do preceding year basis. So what happened to the third year? This is naturally the first year, 2018. Second year will be 2019. Third year will be 2020, right? So what you will now do is the basis period will be what I will start from the end. It is from the third year that you recognize the account year end. I told you in the first year, you ignore the account year end because you have to start from the date of commencement and it will end on December 31st. It doesn't matter what your account year end is. The second year, it will start again from date of commencement and is going to count 12 full months, ignoring your date your account ends. But now in the third year, it recognizes the date the account ends. So I will come here, I will start and I will say this is 31st of December. But watch it, this is 2020. It must be preceding year basis. Now this is going to be 2019. Now because this is 31st December, this is where it ends. How do I get the beginning? If I am standing at 31st December and I want to get the beginning, the way I did here when I'm standing at April 1, I asked myself, what was yesterday's date, right? That was how I got the ending. If you are standing at the ending and you want to get the beginning, you say, what is tomorrow's date? Tomorrow's date is going to be January 1, but since it is 2019, it's going to be, apart from being 31st December, if it is any other year that is not 31st December, you would have written the previous year. But now, because it's 31st December, you are going to also put 2019. So you see here, this is a technique we usually use during the old accounting year that ended, the old finance, the taxation period that stopped being used in 2019. Now, can you see that there is an overlap? Now, where is this overlap now? In the 1st year, there's an overlap. Everything in this first year is covered in the second year, because here is just about 9 months, and here is about 12 months. So these 9 months here is included here in these 12 months. That's one. Then there is an overlap here. January is here, February and March. So this January here up till March can be found in the second and the third period. So there is an overlap that occurs in 1st January to 31st March of 2029, which is due to transition. So that is what they are saying. This is due to transition. And so if ICANN is giving you question and you are seeing a question in taxation, please, the dates are important. The date will enable you to know whether you are using the old Finance Act or the old tax law or the new Finance Act regime. So always take note of the date. Look at illustration 7. All right. A due enterprise. So now this is an enterprise, which is an individual. This one we did here was a company. So now this is an enterprise. Their due enterprise commenced business on what date? Let me change the color of pen here so that we'll enjoy it. So a due enterprise commenced business on what date here? 1st April 2019. So this is the date of commencement, and it makes its account up to 31st December 2019. Now, what is this saying? The first year's enterprise falls under what? The old provision. Now, it says here that because it starts business in 2019, the year of assessment is going to be 2019. Okay? Why? Because it starts business in 2019. What is the basis period going to be like? Just like we did before, business commence, which is April 1, 2019, and it will end in 31st December. It doesn't matter where your business accounting year end is. So it's going to be 31st December 2019. Now, incidentally, this is also when the business is ending its own. If you look at that of company, it was still the same thing, but it doesn't matter whether it is the same thing. Now, in the second year also falls on the old provision. Now, like we did before, year of assessment for the second one will be 2020. You see, we said Finance Act started in year 2020 for companies which are assessed in 2019 year of assessment. And it starts for individuals for 2021 year of assessment, which will be assessing profits based on 2020 accounting year. So you see, this is year of assessment 2020, and the basis period shall be the first 12 months. So you will go back and you say April 1, 2019 when it started, and it will take you the first 12 months. And I'm standing in April 1, and I'll ask myself, what is yesterday's date to be 31st of March, and I will put the next year date, which is 2020. All right. Now, the third year of assessment is 2021. So, year of assessment is 2021, and the basis period shall be from, that is when now you will now recognize the account year end. And I will come here and I will start with the account year end, 31st December, and I will look at it. This is 2021 here. It must end in 2020. Now, that will mean that this has started from January 1, 2020. Now, when you've done the third year, it is the pattern the third year is, that is how the subsequent year will be. So subsequently, you'll be starting from January, like in the fourth year, to be January 1, 2021. It will end in 31st December 2021 normally. Now, if you can look at it now, there is an overlap in January 1, 2020 up to March 31st, 2020, due to the transition. So don't just think that ICANN will just give you only the new rule. No, they might also test your knowledge. It came recently, one of these recent questions, they set a question that made tax people, the students had to apply the old rule. So you may need to know a bit about the old rule so that you can be able to flow. Okay. Now, determination of the end of first accounting period. The determination of the first year of assessment and the relevant basis period is based on the taxpayer's period end. So it is based on the taxpayer's period end, not the government accounting date, which is 31st. Therefore, the first accounting period of a company or individual is the date of commencement to the end of its accounting year end. All right, look at illustration 8. ABC Limited was incorporated in July. So this is incorporated. Let me change this color so that we will like it. Now, this is date of incorporation. So this date here is, this is not date of commencement. This is the date that the CAC issued the certificate. Now, it commenced business on what date? 1st of September. So this is the date of commencement. This is CAC date of incorporation. Now, the company's first set of financial statements covering 16 months was given to us. So they give us 16 months covering from the date it commenced business in 2019 down to 31st December 2020. Now look at it now. The end of the company's accounting year period is 2020 and not December 2019. So the end of the accounting year is December 2020 and not December 2019. Therefore, its first year of assessment will be in 2021 because the assessment year, the accounting period is ending in 2020. which falls under the new provision. The company the profit of the company shall be that of 1st September 2019 to 31st December 2020. So the second year will be 2022. 2022, which falls under the new provision. So because this one ends in December 31st, this one will start in 1st January and will carry on to December 31st, 2021. And the third year, which is 2023, shall be the same pattern from January to December 2022. All right? This is because it was incorporated in 2019 and started business in September 2019. This is a company. Now look at an individual, was incorporated in 2020. So this is the CAC date. This is date of incorporation. And now this is date of commencement. And the first set of financial statements covers 16 months from this down to this, from 1st September 2020 to 31st December 2021. The end of the enterprise first accounting period is December 2021 and not December 2020. So therefore, its first year of assessment should be 2022, which falls under the new provision, right? Normally, 2021 also falls under the new provision. All right. The income shall be from 1st September 2020 to December 31st, 2021. And the second year shall be 2023. It will start where the first one ends, January, and end in the account year end. And the third year shall be 2024, and you shall start from where the second one ends, January, and ends in December. That's it. So we've seen cases where businesses started in 2019. So this starts in September 2019. Let's compare it with what was done here. Okay, 2020, April 2019. Okay. All right. So we've seen how these things works here. There is no overlap. There is no overlap in the years of assessment when 2 years are determined. 2 years of accounting or tax years are determined. And we see that the first year of assessment and the relevant basis period on the taxpayers period is based on the taxpayers period end. So it means that where the taxpayer has prepared his accounts to, that is where it is being used. So if these people here, we did in illustration 8 here, if they prepared their account statement from 1st September 2019, if they prepared their first set of financial statements up to December 2019, that is what we would have used as our first year. But because they've prepared it for 16 months, So it means that the first set of financial statements shall be less than 12 months, shall be even more than 12 months, it could be more than, it could be 18 months, it could even be 23 months, not 24. So the first set could last from anything to 1 month, 1 month to 23 months. How can we use 23 months? It means that if they start their business, even 23 months is even too much. 18 months is just the ideal. 18 months is just the ideal, although it is not stated explicitly in the months in the Finance Act. But the clarification here is that the account should, the first year's account should be in line with the entity's financial statement based on the entity's period end. Most times it is when it is less than 6 months that this is even applicable. So it means that if an entity perhaps starts from July and perhaps instead of ending in December of that year, it ends in December of the following year, that's about 18 months. Yes, it can cover it up to 18 months. But once it is getting to 19 months, I don't think it's going to cover. Yes. Do you know why it's not going to cover? Because normally your first 18 months of business is going to, during your first 18 months of business or 18 months of incorporation, your first set of financial statements should have been prepared, whichever comes first. So 18 months after incorporation or 6 months after the end of your accounting year end. All right, now that we've seen commencement of business, which is the major focus tonight, let's look at this question once again. Now, I'm going to solve this question using the old rule. Then we are going to adjust this question again to make it look like 2026. Then this one will look like, let me write this by the side. We are going to solve again to make this look like 2027, 2028, and 2029. That way we are using the old rule and the new rule. All right, so let's start. So this is exercise 1. I'll come here. Exercise 1 here. This is our exercise 1. All right. In our exercise 1, our company is AYZ Company Limited. So this is a company. So this is AYZ Limited. All right. So what are we doing on AYZ Limited? We are asked to do what? Compute the assessable profit of the company for the relevant years of assessment in line with the rules of commencement of business. And they say, and the alternative available to the taxpayer. Now, this alternative available to the taxpayer is during the old law, which we will do now, and we'll also do the what is applicable in the new law. So I will now say, using the old tax rule, tax rules. All right. Now, what is the old tax rule? We look at the date the business commenced. This is our date of commencement. Our date of commencement here is, this is our date of commencement, and this is our account year end. So the date the business commenced is what? 2006. So what do we do? In the old rule, this is your year of assessment. This is your basis period. Then this is your assessable profit. So that's how we're going to work it out. So all right. So because the business started in the year 2006, it means your year of assessment for the 3 years should be 2006, 2007, and 2008. So this is the period that we are looking at. Now, because you also have 2009 included, you will not just stop at 2008. But let's see what will happen. When they say relevant years, it means here that solve for as much as the question can carry you. Don't just look at the 3 years and say, okay, no, I've done the first 3 years. No. Solve as much information as you can from the question. They are all relevant. So your first year in the old rule is from the date the business commenced to 31st December. That was what we said before. The business commenced in April 1, 2006, and it will end in 31st December 2006. Let me use 06 and let me be consistent. Let's be consistent. 06. Now, what will be the assessable profit? We are given period ending June 30th, 27. So because we are given period, this period started from when? It started from April 1. So from April 1, 2006 to June 30, 2007, April, May, June. So this is 15 months. This is 15 months. Like what we read before, if it were to be this new rule, we would have used the 15 months, because this is the taxpayer's financial statement prepared to. But now the old rule says it doesn't work that way. Your first year of assessment must be from when the business starts to December 31st. And we have 15 months in it. So you are going to take between April to December is 9 months. So you are going to take 9 months out of that 15 months. So what is it going to be? This is 1,800,000. So 9 over 15 times 1,800,000. So what is it going to be? Let's activate our calculator. Our calculator has been inactive. Let's activate it now. All right. We have 9 divided by 15 and multiplied by 1,800,000. That will give me 1,080,000. So I'll come here, 1,080,000. I'll write it down here, 1,080,000. Now for the second year, what do? We will say for the second year, it will start from where we commence business. This time around, we are looking for 12 months. So what do? We go back to where our business commenced. It starts from April 1, 2006, and we are doing 12 months. So if I'm standing in April 1, let me write this thing well so that to not cause confusion. This is April 1. So if we are standing in April 1 and we want to look at what is yesterday's date, that should have been 31st of March. All right. Sorry, this is going to be 2007. 31st March 2007. So that's what it's going to be. But we have here April 1 for this period ended, and we have up to June 30th. It's still 15 months. We are taking 12 months out of that 15 months. So can you now see that there's an overlap in the basis period, and we are charging this account, this 1,800,000, we are subjecting it to 2 tax. So this is going to be 12 months out of 15 multiplied by 1,800,000. Now this is going to give us how much? Let's calculate. 12 divided by 15 and multiplied by 1,800,000. That will give me 1,440,000. So I'll come here, 1,440,000. All right, that's the second year. Now the third year is when we will now start doing the preceding year basis. So I will come here and I will put something like this. The account ends when? Account ends in June. Account ends in June. So that's noted. Now, since your account year is June, it's going to be June 30. But watch, because this is 2008, here must be 2007. So that it will be preceding year. And because this is 2007, June 30th, and I'm standing here, what is tomorrow's date? It's going to be July 1. Then I'll take it back 1 year, 2006. So I'm going to be looking at July 1, 2006. Where can I find July 1, 2006? This account also start from April, May, June, July. There is a July here. July 1, 2006. So this first account has been subjected to 3 charges of tax. That's what we are saying, overlap. So because I'm looking for July 1, sorry, I'm looking for July 1, yes, 2006. I'm going to be looking at this figure and I want it to end in June 30th, 27. And this is an account ending in June 30th, 27. And I'm going to be taking 6 months out of 12 months out of it. So it's still the same calculation we did here. 12 over 15 times 1,800,000, and that gives me 1440. And that's for 2008. We can continue and say 2009 will follow the pattern that was done in 28. So because this is June 30th, 2007, here becomes July 1, 2007, and it will end in 30th June 28. And we'll look for the account ending in 30th June 28. Is this 105? We'll pick it straight. We'll pick it straight. How much is it? 1.5. We'll pick it straight. 1, 5. Then we'll do the next one. 2010. It will follow the same pattern. First July 2008 to 30th June 09, and we'll pick the account there, 1,800,000, because it's 1 year's figure. This is 1,800,000. Now what we've just done now is the old rule. This is the old rule. All right, now let's look at the second part of the question. And they said the alternative available to the taxpayer. Now, what is this alternative all about? This alternative is telling you that for the second year, and the third year, instead of using what we've just done, we will use what they call actual year basis for the second and third years. So second and third year will be actual year basis. Already this first year is in actual year basis, because how do we know an actual year basis? The start of the basis period and the end of the basis period will be the same year. So we know an actual year basis period 2006. This is 2006, and this is 2006. But in this case, this is partly last year and actual. So it's not actual because there's a part from the previous year. The same thing here. This is also not actual. This is actually preceding year. So for these 2 years, year 2 and year 3, we are asking to do it on actual year basis. So we'll come down here and say alternative to, okay, available, alternative available available to taxpayer. Okay, so this is the alternative that is available to the taxpayer. So we'll come down again and we'll say this is our year of assessment. This is our basis period, and this is going to be our assessable profit. And we are going to use the same periods we use: 2006, 2007, 2008. Then we'll come up here again and say 2009 and 2010. Okay, this is where the question ends. So why am I ruling line under the 2008? Because that is where the normal commencement rule ends, where we apply the method, and from there everything has been set and we'll carry it from that pattern. All right, so this line is not straight. All right, so all right, now we said in the first year is always from when the business commenced to 31st December of that same year. We did that calculation before. It doesn't change here. This is going to be 9 months out of 15 multiplied by 1,800,000. And the last time we did it, we got 1,080,000. Just to check if we are correct, let's see. That's correct. Now, for the second year, we are saying that the alternative way available to the taxpayer is to assess 2007 and 2008 on actual year basis, meaning that this must be January 1, 2007 down to 31st December 2007, and this must be January 1, 2008 to 31st December 2008. That is what it means. We will now go to the question and see where can we get January 1, 2007. January 1, 2007 can also be gotten from this period, this first period. Where can we get December 2007? We'll get it in the second period. Now, when we do that, January can be found here. From January to June happens to be 6 months. So we'll take 6 months from here, then we'll take the remaining July to December from here. So that's what we're going to do now. We will say, open a bracket, 6 over 12 times 1,800,000 plus 6 over 15. 6 over 15. So the first one was 6 over 15. And this one will be 6 over 12 times, what was that figure again? 1,500,000. 1,500,000. 1,500,000 500. All right. So what do we do? Let's set our calculator. This is going to be 6 divided by 15 years times 1,800,000. That gives me 720. Now let me bring a second calculator. So the first one gives me 720. So I'm doing the second one here. 6 divided by 12 and multiplied by 1,500,000. That gives me 750. So I will be adding 750 to 720. So let me add plus 750. So it gives me 1,470,000. So that's what I'm going to write here. 1,470,000. 1,470,000. All right. So this is the second year. Now the third year, what do we do? We're going to look for where we will have January 1, 2008. So January 1, 2008 can be found here. We'll take 6 months from it, and the other 6 months will be gotten from here. So that's what we'll do now. We will say 6 over 12 times 1,500,000 plus 6 over 12 times 1,800,000. 1,800,000. We'll bring out our two calculators as before. We have already done the 6 over 12 of 1,500,000 and we got 750. So no need doing it again. What we'll be doing now is 6 divided by 12 times 1,800,000, and we have 900. So 900. So add 750, and we have 1,650,000. 1,650,000. So you come here and you write your 1,650,000. 1,650,000. Now, before you proceed to the 2019 and 2009 and 2010, the law says here that when you do this alternative method, you will need to sum these two and compare with the one you did before. And so let's sum them up now, and I will explain to you why we are summing. So here we have 1,470,000 plus 1,650,000. Sorry, 1,650,000. What am I doing? 1,650,000. It gives me 3,120,000. I'll write it down here. 3,120,000. All right. We'll go to this one here. So let's sum with the other calculator. We are summing these 2 years, just these 2 years. Okay. So I will say 1,440,000 plus 1,440,000. I have 2,880,000. So I will have 2,880,000. Note that you are only summing the second and the third. Why? Because the first one is already the same for the two methods. The first one is already the same. You use the same method for the two. Now, when you sum these two, which are you expected to pick? Now, the taxpayer, they call it taxpayer's right of election. Would you want to pay a tax based on your profit of 2,880,000 or profit of 3,120,000? Of course, these 3 years would have suffered multiple tax. So the taxpayer is allowed to choose which one of these will give him a lower taxable profit. So the taxpayer will opt for this 2,880,000. And where did he get it from? He got it from the first method. So when he gets it from the first method, he will forego his right of election. So it means that he is telling the taxpayer, I want to be assessed based on this one that gives me a smaller figure, and I will forego my right of election. So I will not, he will calculate this and say he will forego this right. Now, assuming this one was smaller than this, so let's say this here was 2,120,000, he will be telling the taxpayer that, look, I appreciate the fact that I did this and I got 2,880,000, but I will exercise my right of election and I will choose the smaller one. Now, this can only be achieved in the second year and third year, which will be added. So it means that, now note, you're not comparing second year of the first method and second year of the second method. No. Neither are you comparing the third year of the first method with the third year. No. You are summing this first and the second and third year, then you sum the second and third year of the other method. You are comparing the total for those two and checking which one is smaller. Anyone that is smaller, you just copy and paste it in your template that this is your accessible profit for that period. All right. Now that is done, let's look at the other year. So this is the fourth year. Now it will start from, note here that when you use your right of election in this second and third year, it doesn't matter which of them you choose. It doesn't matter which one of them you choose, whether this one here or this one here. In all cases, your fourth year of assessment will be on preceding year basis, and it will be based on the account year end. So I will come here and I will say, this is, what is your account year end? You will check, it is June every year. So what will I do? And I will come here and say, this is June 30. Now, because this is 2009, here will be 2008, so that it will be preceding year. And if this is June 30th, I'll ask myself, what is tomorrow's date? This is July 1. Then I will say 2007 to June 30th, 2008. I have an account ending in 2008, which is 1,500,000. 1,500,000. Then the next one here is July 1, 2008 to 30th June 2009. And we have it as 1,800,000. Now, if you note now, the two method here, year 2009 and 2010 happens to be the same thing. The difference in the method lies in the second year and the third year. That is where the difference lie in the second and the third year, because the first year is the same. And remember, you choose the set that gives you the smallest figure. You choose the set that gives you the smallest figure, and you forgo the one that gives you the higher figure. Now, that is what the commencement rule states in the previous tax regime, which is what this question was asking you. Which is what this question was asking you. All right? So, in this question here, we said, do not exercise your right of election. Why? Because the sum of the 2 years in the first one is smaller than that of the second one. Because when we sum them here, look at what we got. And when we sum this, so in this manual here, we solve for the 3 years. We didn't solve for the other years, but the question says relevant years of assessment, and I've interpreted it to mean solve as much as the question can carry. Your question can carry up to 2010. Okay, so we have now twisted the question to accommodate the new Finance Act, and we said we'll call this one 2026. Let me write it down here again with a different color. All right, so we will call this 2026 2026, and this should be 2027, 2028, and 2029. Okay, so what do we need to do in this example? Now let's go and do it the Finance Act way. And I'll say, using the Finance Act 2019 method. I'll say here, in this question, just note that we have converted it from 2006. Now, that doesn't mean that in the exam you will convert to 2026. No, you use the question as it is. But for the sake of lecture, just assume that the question has changed, that we have, instead of 2006, that the question is originally stating 2026. That doesn't mean that in the exam you will be the one to convert. No, that's not what I'm saying. Okay, now this period from April 1, 2026 to June 30, 2027 happened to be 15 months, right? That is what we just learned. So I will come here and I will say, this is my year of assessment. This is my basis period, and this is my assessable profit. Okay, so what do? We'll say the first year of assessment, don't do anything about the year of assessment. First of all, come and do your basis period. Your basis period starts from when? Date of commencement, which is 1st of April 2026. And when is the taxpayer's first year ending? It prepares it to June 30, 2027. So we are going to say to 30th June 27. Okay, now because this is 15 months, right? Now because this is 2027, our year of assessment will be 2028. And that's it. That's the method. Put the basis period first for the first year, start from the commencement date, end at the account year end, that the businessman brings the first financial statement, I think which must not be more than 18 months. Put the year of assessment to be preceding year basis. Now, what is the assessable profit? It's simple. We have been given 1,800,000. No workings. 1,800,000. That's it. The next one shall be 2029. And it shall be from where the first one ends, which is, if I'm standing at June 30th, tomorrow's date will be July 1, and that is going to be in 2027, July 1, and it's going to also end in 30th June 2028. And once again, no workings, 1,500,000. Then this is 1,500,000. Then the next one will be 2030. This should be 1st of July 2028 to 30th June 29, and as it's given, 1,800,000. Now note here, there is no alternative for the taxpayer. And you see here, it is only done in 3 years. The 3 years is what it can cover. Unlike the other ones that it will cover up to 5 years. Now, there is no alternative available to the taxpayer. Why? Because you don't assess income tax on actual basis, either for a business or for an enterprise, for a company or an enterprise. They are all assessed on preceding year basis. Always. And you notice there is no gap nor overlap. So you can appreciate the beauty of the Finance Act 2019 that smoothens everything, and you didn't do any workings in this example, unlike the previous ones where a lot of workings had to be done. Now let's look at the second question. We are told here, Liadi Trading Company Limited. Now, this is a company, not an individual. It's a company. This company decided to change. Okay, no, this is a change of accounting. Let's leave that. Let's see whether we'll see another one. Oh, this is the third one is cessation. Now, after we finish our cessation and change of accounting date, we shall be doing this particular exercise that has everything from commencement to date of cessation and change of accounting date. But let's look at maybe an old question here. Let's look at commencement of business. Where can we find it? Let's check. To tell you again, for you to, okay, now let's look at this one here. This is November 2016. Of course, it's going to be the old method that is there. We'll still tweak it to the new method. And I'll also tell you that when you are learning pioneer legislation, you will be required to do commencement or cessation of business. All right, so let's look at November 2016. Let me get the question. November 2016. Just a moment, I'm getting that out now. November 2016. November 2016. And it's going to be question number 1. All right, so let's get to where it is. All right. Let's be sure it's question number 1. November 2016, question number 1. Now, ZZ Nigeria Limited was incorporated on September 7, 2012. Now, this is our date of incorporation. Now, but it did not commence business until July 1, 2013. Now, this is our date of commencement. Based on the memorandum and articles of association, the company was incorporated to carry on the business of distribution, ship, and general contracting. Extract of the company's statement of profit or loss and other comprehensive income are given below. Now, this is 6 months ending in 2013, 1 year ending in 2014, and another 1 year ending in 2015 December. Now, it means that December 31st happens to be their account year end. Now, if you look at it here, this account for the business was brought in 2013 December, even though they started July 1. Okay, now This has other information which we will adjust to get our accessible profits. Okay, we will adjust. So this is a quite higher question than what we were supposed to do here. This is quite higher, but we will still do it. Okay, we are asked to determine the accessible profit or loss, to determine the accessible profit and loss, and advise the company whether to exercise its right of election. Compute capital allowance, we will not do that. Compute the tax liabilities, we will not do that. We will be concentrating our effort here on this and on this. Okay, so what do? We are going to go to our whiteboard now, and I will say this is November 2016, question number 1. I'll say I can. Okay, now the name of the company is ZZ Nigeria Limited. So you start scoring marks when you are putting the right thing. ZZ Nigeria Limited. All right. What are you asked to do? You are asked to do adjusted profit and loss. So the A part is adjusted profit and loss. Okay, so what you do now is you bring your adjusted profit and loss. So you will say period stroke, sorry, let me clean this and let me make it well. This is your A, and I'll say period stroke year end. So we'll look at the year end and the period end that are given to us here. We have them in 2013 down to 2015. 2013 to 2015 period. So year end 31st December, and I'll put 2013, 2014, and 2015. All right. So these are our period ends. So what do? The first thing to do is to bring the net profit that was given to us. The first one was a loss and a profit. So I will come here and say net profit stroke loss. What do we have here? 652,550, 652,550, 652,550. This is in bracket because it's a loss. 4,269,470. 4,269,470. Am I correct? I think so. And the next one is 7 million 244 800. 7,244,800. This is a profit. All right, so the next thing now to do is, how do we adjust this profit that was submitted to the tax office? We'll look at what was involved here by going to the additional statement. Other income includes scraps, sale of scraps. Sale of scraps are not. Now look at this income that we've got here, revenue. Okay, other income. This 45,458, 458, 150, and 201 is what they just described here for us. So some of them are not allowable. For example, sale of scrap is not an income that should be included, because this is not this is capital sales of capital assets. Then interest received on treasury bills is fine. Interest on domiciliary account, what do we think? Interest on domiciliary account are not included. So we're going to include this, remove all of these because they are not taxable. So we will go here and say less non-taxable income, because they have been included before. We are going to less them. Less non-taxable income. You will now say interest on domiciliary account. So we have 45. We are lessing it. We also have what again? 76, 150. 76, 150. Then we have 81,000. All right. Then after looking at that, we go to the next one. Administrative expenses include, so we've left income, which was included before. Now we are lessing it out. For the expenses, they have been deducted before, so we're going to be adding them back, those that does not qualify. We have depreciation, doesn't qualify, we'll add that. Preliminary and formation expenses, they don't qualify, we'll add that. Fines and debt, penalties and fines, they don't qualify, we'll add them back. General provision for bad debts, they don't qualify, we add them back. The only things that are allowable here is staff salary and office rent. So the way I'm going to do this here is that I am going to add them here and bring the figures the other way to save space, or we can still do it that way. Depreciation, let's take it that way. Depreciation, I can come and say add back. Okay, add back. Okay, let me write it in full. Add back disallowed expenses. So we have depreciation. And how much is depreciation costing us? Depreciation is said to be 160, 320, 440. $160, $320, $440. The next one happens to be preliminary and formation expenses, 216. I will put my 216 here first. Now say this is prelim and formation. Okay, of course, here is dash, here is dash. Then the next one is fines and penalties, 65,000. Fines and penalties, I have it here as 65,000. So I'll come here, fines and penalties. Penalties. Fines and penalties. Dash and dash. Then the next one will be general provision for bad debt. 110, 180, 240. 110, 180, 240. And I will say general provision for bad debt. Okay, what next is remaining? That's it, right? So what we do now, we will look at the next set. Okay, so the others are plant and machineries, which does not affect profit. Okay, these other ones does not affect profit. So what we've just done here, we can now adjust. So we can now underline this, and underline this. I'm going to be getting my adjusted profit in a short while now. So my adjusted profit is going to be answer here. So let's bring our calculators now. So let's start with the first one. 652,550. You know it's in brackets, so I'll click on this minus plus minus here to put a minus sign beside it. Minus 45,000 plus 160,000 plus 216,000 plus 110,000, and that gives me minus 211,550. I'll put it in brackets, 211,550, 211,550. Now this is my adjusted profit or loss. Say or loss. So this is 211,550. All right, what's the next one? We have 4,269,000, 4,269,470 minus 76,150 plus 320,000 plus 180,000. That gives me 4,693,320. 4,693,320. Now let's look at the last one. We have 7,244,800 minus 81,000 plus 440,000 plus 65,000 plus 240,000. That gives us 7,908,800. 7,908,800. Now this is your adjusted profit. That's what the question is asking you. Now, adjusted profits and accessible profits, are they the same thing? Let's find out. Okay, now determine the accessible profits and loss and advise the company on whether to exercise its right of election. So let's go further. So we are asked to now do accessible profits. So the B part here now is the B part accessible profits. Okay, so what do? We will start with our year of assessment, basis period. This is too small for basis period, so we'll come here and accessible profit. Accessible profit. All right. So what do we need to do? We'll go back to our adjusted profit. So because your account year ends in 2013, okay, and now this is the old rule. The business started when? July 1. So it means that our first year of assessment will be on 2013, the year that the business started, and it's going to be on actual year basis, July 1, 2013 to 31st December 2013. Okay, that's the first year of assessment using the old rule that we learned. Now, what we have here is from July to December. So we are going to take these 6 months here that we have here, this loss that we have here, 211,550 That's the first 6 months. Then I think that's it, because this is ending in December 31st, 2013, which is what we are hoping to arrive. So your accessible profit is this particular figure here, 211550. So that's for the first year. I will double underline it. Then the second year of assessment is 2014, and we said it's going to start again from July 1, 2013, and it will be 12 months. So if I am in July 1st, yesterday's date will be 30th June, then I will say 2014. So what I will do now is, this is 1 year figure. I will take the first 6 months that we've gotten before, which is a loss, plus what we had here. I will take 6 months out of it. 6 over 12 times 4, 693, 320. All right. See the systematic way I'm solving it. All right. So I'll close the bracket now, and I will now deal with these ones now. I will say 6 divided by 12 multiplied by 4693, 320. Now, this is what I'm getting for just this part. Now remember, this is a minus. This first part here has a negative figure. So I will just, at this time, I will minus it. So I will say minus 211,550, and I will get 2,135,110. 2,135,110. 2,135,110. And that's my second year. Then the next year will be 2015. Now in 2015, that is when I will begin to do my preceding year basis. So I will say, since it is 2015, it must be on account year ending in 2014. And when I look up here, I am seeing year of assessment, no, account year ending in 2014 December. So December is my account year end, and I will say 31st December 2014. So this must begin from January 1, 2014. So I will go and look for an account ending in 2014 December, which is still 4693, 320. 4693, 320. So now that's the second year and the third year. Now, before we continue further, let us do that calculation we normally do when we do first and second and third year. So we will now look at this, and we will say 2,135,110 plus 4,693,320, and that gives us 6,828,430. 6,828,430. Now this is the addition of these two that produce this. So we'll remember this figure when we want to do our right of election. So now let's go to the next year. So the next year will be 2016. 2016, it will be January 1, 2015 to 31st December 2015. And so we have an account ending in 2015 December, and that is 7,908,800. So I'll come here, 7,908,800. Now you have done the first one. You now want to check if you need to forgo your right or exercise. So I will say tax payer right of election. In the taxpayer's right of election, this is year of assessment. This is your basis period, and this is your assessable profit. The first year in both period will be the same. So no need cracking or racking your brain. Just take what you did in this first period, repeat it also down here. Year of assessment will be 2013. The business started in July 2013, and you will do it to 31st December 2013, and you had an assessable loss of 211,550. And that's the same thing you had here. The second and the third year is what decides whether you are going to choose the right of election. So now, the second year, which is 2014, you are telling the taxpayer, I want to be assessed on actual year basis. So this will now be January 1, 2014 to 31st December 2014. Fortunately, we have that here, 2014 December, so it must start in January. So we'll take it out there, 4,693,320. 4,693,320. Then we have our 2015, which is going to be from January 1, 2015 to 31st December 2015. Fortunately, in this question, we have it here, 2015 December, 7,908,800. 7,908,800. And then we remember that we are supposed to do our right of election. So let's add these two up. We have 4,693,320 plus 7,908,800, and it gives me 12,602,120. 12,602,120. 7,602,120. Now, when you compare this with 6,828,500, 430. Of course, you will want to choose this, and you will want to reject this. So you will say advice, do not exercise your rights. Keep writing. My writing is um, I apologize for my writing. Do not exercise your rights. Okay? So of course, you've done 2015. You can do your 2016. Your 2016 will be the same thing we did before. 2016 is going to be on preceding year basis now instead of actual year basis. It's going to be on, this is 31st December 2015. And of course, this is going to be 1st of January 2015. So your 2016 is the same thing you did here, which is you did before, 7,908,800. So it means that in your financial statement, the first year in your tax, your first year is going to be this same thing in your assessable profit. The second and the third years are going to be these two figures because this sum is better than this. And your fourth year is going to be this, is the same thing here. So it means that what you did in this last as taxpayers' right of election is not, you are going to abandon it because you are not exercising your right. So you're just going to follow these. So with this, we have solved this question partly. We've solved it partly. So I will say, sorry, we've solved it partly. I'll say solved partly. So we only solved here, we only solved tax liability. We have not solved tax liability. We only did commencement and right of election. We didn't do tax liability. So here, 2016, so you just indicate that you have touched this question. So you just give it a small good, and you are going to revisit this. You have not finished solving it. So we are going to come back when we learn tax liability. We'll come back to this. Now let's see if this question had changed, and if it was 2022 that was here. Let's assume it was 2022 and here was 2023, and of course this happened to be 2023, 2024 and 2025. What is it going to be? So we are going to look at this question again, and we'll say Finance Act 2019 method. I will say here, note, we have converted the date to fall within 2022 down to 2025 so that Finance Act 2019 can be applied. I told you before, you don't need to convert in exam. I'm not asking you to convert. For the sake of this class, we converted the question so that we can use this method to solve, because this is the main thing I'm supposed to be teaching you. But the other one, for you to understand that question and solve it, we need to solve that question. So we have our adjusted profit is going to be the same. It's going to be the same. This adjusted profit, it doesn't change with year of assessment and all that. It is the assessable profit that is the difference. So we are doing the B part again. Assessable profit. Assessable profit. We come again. Year of assessment. Basis period. Assessable profit. Okay, so what do we have here? We look at the date in which the company commenced. 2022 is date of incorporation. Commenced business July 1, 2023, and its first set of accounts was brought in December 2023. So because it commenced on 2023 July, we'll come here and say 1st of July 2023 to the end of the first accounting year, which is 31st December 2023. Now, for us to achieve preceding year basis, this has to be 2024. And the assessable profit, we've just been calculating it all the while, is this. It's a loss, 211,550. So we'll come here, 211,550. Now that's a loss. Then we have our 2025, which is going to be from where this one stopped, January 1, 2024, down to December 31st, 2024. Our assessable profit is still 4,693,320. 4,693,320. And of course, we have 2026 year of assessment to be January 1, 2025, down to 31st December 2025, and it will be based on accounting year ending in 2025. 7,908,800. 7,908,800. Now, in this example, our adjusted profit equal to our assessable profit. Now, in the old rule, your adjusted profit was not equal to the assessable profit in commencement because of the workings we need to be doing. But in the new Finance Act, your adjusted profit is going to be equal to your assessable profit as long as no carry forward loss exists. So as long as no carry forward loss exists, your accessible profit and your adjusted profit will be the same. So sometimes you'll be seeing us using them interchangeably. Accessible profit, adjusted profit, the same thing, as long as there is no carry forward loss from the previous period. And in this question, there was no loss from the previous unrelieved loss from the previous period. Okay, so when we learn capital allowance, we'll come back to this question and we'll fix it, and then we'll now look at the tax liability for this question. So what have we learned today? We have learned quite a lot. We've looked at the FIRS circular explaining the commencement of business. We've seen that the Finance Act 2019 accommodates businesses that commenced in 2019 for companies and for enterprises that commenced in 2020. We've seen what the first year of business would be, the second year, and the third year. And we've also seen that the first accounting period shall be from the date of commencement to the first end of the first set of financial statement that is brought by the taxpayer. So they can bring 6 months if they want to, they can bring up to 18 months. Okay? We also saw that if a business as a company is incorporated or is commencing business in 2017, it is possible that the first and second year will be in the old rule, and the third year, which falls in the new rule, will have an overlap. For enterprises, the first and the second year, if it commenced in 2018, will fall in the old rule, and the third year will fall in the new rule with an overlap. We've seen how a question was being solved, and we applied the old rule and we applied the new rule so that you get abreast with these two, so that anyhow the question comes, you can solve. And so that when you are looking at past questions and you are seeing how the solution is being solved, you will understand it and it will make sense to you. So that's why we need to learn the old method and the new method. In our next class, we will be looking at change of accounting date. Is it covered in the new Finance Act? What should we know about that? So that's what our next class will be. And like I said before, this question trend, you need to look at it and see which other questions you can solve, based on what we have learned, and most especially check November 2019 that is not covered here down to the current period. You will see some questions that really borders on the new rule. So that's what we will be using most often. So at this point now, I would like to ask if you have any question. If you have any question, feel free to ask them before we close for today. I'll give us a minute or two to ask a question and let's see how we'll answer them. Okay, there is no question. I think it's a good time to close for today so that we can relax and prepare for the next class. So once again, I say thank you so much for coming to class. Please make sure you watch the video that will be sent to you so that you can practice and see how you will understand this topic, because this is the foundation of your knowledge of taxation. Thank you so much and see you again in the next class.